The stock of the day is brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended trading hours on key US shares and competitive spreads, all on an award-winning platform. Get started at IG.com.
And our stock of the day is Iress. So Iress has launched a business efficiency drive aimed at permanently lifting margins. It's also confirmed its guidance for 2025. Adjusted earnings is forecast to come in between $128 and $132 million following the sale of 6 non-core businesses. Underlying profit after tax is forecast at between $67 and $71 million. And the share price is doing pretty well today. Last I checked, it was up by about 5, going on 6%. Let's get a fundamental view to start with David Lane from Ords. Is Iress making the right moves in your view?
Yes, I think it seems to be. They've come out today and reiterated that they're on target for their guidance, and that was pretty much in line with what the market had been expecting. But I think what the market is excited about today is their business efficiency program and the fact that they're doubling down or focusing on their wealth and trading activities. So the data that we're looking at on the chart is from Iress itself. I'm looking at an Iress screen, so we're definitely customers of Iress, and they've got a very good market share in Australia, both in terms of market data like charts and share prices, but then also for financial advice with their X-Plan program or tools. That accounts for about 50% of financial advisors around Australia. So it is a good business. They do have a very captive market, and they have been putting through price increases to all of us over recent years. But I think management seem to be focusing on the right things, and if they can achieve their business efficiency as they've proposed, the forecasts are quite positive. So we've got a buy recommendation on them. Our target price at the moment is $10.40. So we think that there is still some upside to the current price. It's not cheap, 25 times PE ratio at the moment, but with the announcements today, if they can increase their profits, that should see about a 15 to 20% improvement in their profitability. So you should see that PE declining over the next couple of years.
Got it. Thank you, David Lane. Let's get a view from David Novak on the stock of the day being Iress.
Yes. Look, I pretty much agree with a lot of what David said. The only thing is, for me, it's the valuation. Again, a lot of these stocks, because we're trading near, we were trading at all-time highs recently, and just the multiples out there are too high for me. I mean, there is a turnaround story here with Iress. However, they've got a lot of competition too in the fintech space and other players. So that could, impact their earnings. But they've forecast 67 to 71 million net profit after tax, which is just under 30 times multiple. It's just expensive. Look, it's a hold at best. I wouldn't be a buy. It needs to break above this resistance level where it is showing that previous peak there, which is about, $9.70. Before it sort of goes to the next level. Like David said, there's a forecast $10.40 there. Could do that. And it's showing some signs of positive, but it's been basically going sideways, this stock. It's, for the last year, it's been trading between $7.50 and where it is right now. So you're at this, what they call resistance level at the moment, technically. So it depends. If you bought it at $7.40 or 50, I would be taking some money take some profits, and holding the rest out, because it is at a major resistance level here. Every time it's hit this level, it's tend to pull back. So, but it just doesn't justify the earnings multiple for me.
Got it. Thank you. So that is a buy for stock of the day, Iress, from David Lane from Ords, and a take some profits for David Novak from Wealthwise Education. Stay with us.
The stock of the day was brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. Get started at IG.com.